In the alternate version of exercise 12-4, we're initially presented with income statement information for Sonnet Company in addition to some select account balance changes, and we're asked to prepare our cash flows from operating activities section of the statement of cash flows using the indirect method. If you recall from the chapter, there's two possible approaches to our operating activities section. There's the indirect method and there's a direct method. Like many companies, Sonnet prefers to use the indirect method, so that's what we're going to use to prepare this section next. The starting point for our indirect method is always net income from our income statement. Recall that's simply just all of our revenues minus all our expenses. Now I'm going to start out with the assumption that our net income from our income statement can explain the change in our cash balance. What I mean by that is it can explain the difference between the beginning cash balance and our ending cash balance. The problem is that for the vast majority of the companies, that statement isn't true. Net income really doesn't explain the change in cash. To be able to do that, we have to make a number of adjustments to reconcile or transform net income to operating cash flow. The reason why is the components of net income, which are revenues and expenses, they're recorded using the accrual basis, not the cash basis. If you recall, going way back to chapter 3, our accrual basis with revenues means we record revenues when we earn them. It doesn't matter to us whether or not the customer paid for that product or service up front. We just care when the product or service was performed in order to record the revenue. On the other hand, for expenses, again, if you recall, we're going to record expenses when we incur them. And that was always a scary term, right? That just means whenever we really use that item up or it really was a cost of the business, we're going to record it as an expense. Again, it doesn't matter when we paid a vendor or supplier for that particular product or service we used up. We're concerned with when it really became a cost of the business, not when cash went back and forth. So what we have to do is transform our net income on our income statement from the accrual basis to the cash basis using a number of different adjustments. I'm going to start out with two major sections. The first section is there's some income statement items that don't have a cash impact. So there's either some revenues that didn't really add to cash or some expenses that didn't really take away from cash, and we need to reverse those. If it was an expense, let's add it back. If it was a revenue, because it previously added in, let's take it back out. So we need to impact them in an opposite direction. Not all of our revenues expenses, but there's a select few. Where are we going to start out with is some non-cash expenses. In particular, the most common ones you're going to have to deal with in this class is depreciation and amortization. Why do we call them non-cash expenses? The reason why is these expenses, while they reduce net income, they don't reduce cash. Let's think of an example, depreciation. So let's say it's depreciation related to a piece of equipment, maybe perhaps you bought 3 or 4 years ago. Well, when you bought that piece of equipment and paid out cash, that payment of cash for that piece of equipment showed up as an outflow in your investing section, correct? Depreciation doesn't resemble cash that's being paid out currently. It's just a way of taking that asset and spreading that cost over the periods at which we think that piece of equipment or building or whatever it is helps benefit. There's no cash impact. So while it currently shows in this period as an expense or a deduction of our net income, it's not really a subtraction of cash. So therefore, we need to add it back to net income, again, in order to get to our true operating cash flow. Similar, there may be some non-cash revenues recorded using our equity method of earnings that we would need to subtract out. These revenues didn't provide cash. That's why we're going to subtract them out. In addition, we have a loss on sale of long-term assets that we would add back, and a gain on sale of long-term assets that we would subtract out. Again, let's think about these last two items. Why is the logic of why we're adding back a loss and subtracting out a gain? Again, let me use an example. I used equipment before when we talked about depreciation. Let's fast forward a number of years and say we're going to sell that piece of equipment. That's an example of selling a long-term asset, selling a piece of equipment. Well, the cash that we get from that sale of that equipment, it's going to show up as an inflow in our investing section. So the loss or gain related to it shouldn't also double dip in our operating section. So we need to go ahead and counteract that by adding back a loss, because remember it previously showed up as an expense and subtracted for net income. So let's add it back, or subtracting out a gain because it previously was adding into net income. Because again, any cash impact of the sale of these items shows up in our investing section. So I know that's tricky enough. That's one major set of adjustments. We also have another major set of adjustments. There's some balance sheet items that we need to make adjustments for. In particular, non-cash, most non-cash, not all, but majority of non-cash, current assets and current liabilities, we need to look at making adjustments to. So let's look at changes in non-cash current assets. We need to make adjustments for them in the opposite direction. For example, if we decrease a current asset, then that's something we need to add back to our net income in order to arrive at cash flow from operating activities. On the other hand, if we have a decrease in a current asset, for example, whether it be prepaid expenses or it be accounts receivable, if it increases, we need to subtract that from net income in order to arrive at cash flow from operating activities. Now, this seems very counterintuitive, I think, to most. If current assets decrease, then I'm going to add it to it. If it increases, I'm going to subtract it from it. How I like to think of this in terms of logic is think of this related to a journal entry. I'm not saying you're making a journal entry for this, but think of this related to a journal entry, which is going to have a debit and credit, right? If we have a decrease in a current operating asset, and let's use accounts receivable, for example. So think about it logically. If accounts receivable is decreasing, that could be due to customers paying, correct? That would be a logical reason why accounts receivable would decrease. Well, if customers are paying, we're crediting the current asset, in this situation accounts receivable, and debiting cash. So that seems to imply that if we have a decrease in a current asset like accounts receivable, we would increase or debit cash. Seems logical. On the other hand, let's think about our increase in current operating assets. In particular, let's think about maybe prepaid insurance. If prepaid insurance is increasing, that likely means we're getting more prepaid insurance, so we're going to debit the current asset account like prepaid insurance, but we got to pay for it, so we're going to credit cash. So kind of explains the logic of our decrease, adding to cash, our increase, subtracting from cash in order to make those adjustments. There's another important section, and that's changes in non-cash operating liabilities. Now, the changes go in the same direction, so we make it a little tricky. Our current assets, non-cash items, go in the opposite direction. Our current liabilities go in the same direction. So for example, increases in current operating liabilities are going to be add to net income in order to arrive at cash flow from operating activities, but decreases in current operating liabilities are going to be subtracted from. So again, let's think about this in terms of a journal entry. If we have an increase in a current liability, for example, let's say unearned revenue. So let's say we're Wall Street Journal and we're collecting newspaper subscriptions in advance. We're going to credit some type of liability account, for example, unearned revenue. But on the other hand, we're receiving cash in advance, so we're going to debit cash. So the logic is increase in a current liability, we're going to debit cash, so we have an increase in cash. On the other hand, if we have a decrease in a current operating liability, let's say, for example, we have a decrease in accounts payable. Well, think about it. If we're decreasing accounts payable, we're debiting accounts payable with their current liability, and we're paying it off with cash, so we're crediting cash. So hopefully that somewhat explains some of the logic behind, because I think if you just try to memorize the rules, it makes it hard, but if you understand a little bit of the logic, it might make it easier to understand how to execute these adjustments. All told, when we make all of these adjustments, we're going to transform net income to net cash provided or used by operating activities, depending upon whether we have an overall inflow or outflow. So that was a quick review. Let's take that quick review and actually apply it to Sonad Company. So we said our starting point is going to be our net income from our income statement, which is going to be $627,744. Remember we said next we're going to look at our income statement and identify any non-cash expenses or revenues. One of the first adjusting items is going to be our depreciation expense of $48,288. Recall that it subtracts from net income, but it doesn't have a cash impact, so we're going to add it back. Similar is going to be our amortization expense for our patents. We're going to add that back for $6,036. Again, it originally subtracted from net income, but it doesn't have a cash impact. Let's look around here and see if we see any other non-cash revenues or expenses. Last and not least is going to be our gain on sale of equipment that previously added to our net income. But remember, when we sell that equipment, that cash flow is going to show up in our investing section. So we're double dipping here. So we're going to subtract that $8,048 for that gain on sale of equipment in order to arrive at operating cash flow. Now, we're not done yet. We'd mentioned we also need to factor in any changes in current operating assets or current operating liabilities. Now, in this scenario, they've been really nice to tell us our increases or decreases in these balances. Sometimes in other problems, they're not so nice. They might give you the comparative balance sheet, meaning the balances for 2 different years, and you've got to figure out whether it's an increase or decrease. So keep that in mind for later problems. But we're going to start out and look at, we've got an increase in accounts receivable. Let's think about this. Accounts receivable was a current asset, correct? We said that if current assets increase, we need to subtract that from net income in order to arrive at cash flow from operating activities. So we're going to subtract that $18,100 increase in accounts receivable. Keep in mind, accounts receivable, if we think through the logic of this too, if we're increasing sales on account, that's debiting accounts receivable and crediting sales, but it's not, and that added to net income, but we weren't really collecting cash. So that gives you a little bit more logic too behind why we're subtracting it here. Merchandise inventory is a current asset. We're increasing it. So our increase in merchandise inventory of $18,200 is also going to be subtracted. Now we look on our other side, accounts payable, decrease in accounts payable. Accounts payable is a current liability. When current liabilities decrease, we subtract the $9,300 decrease in accounts payable. Similar for salaries payable is also a current liability. It decreases, so we're going to subtract the $5,550 in order to arrive at cash flow from operating activities. So we're going to look at depreciation expense of $48,288, amortization of $6,036. Those are inflows, minus gain on sale of equipment of $8,048, minus the increase in accounts receivable, $18,100, minus the increase in merchandise inventory of $18,200, minus the decrease in accounts payable of $9,300, and finally, last and not least, the decrease in salaries payable of $5,550. If we add up all those items, that's a net decrease of $4,874. If we add the decrease of $4,874, that's our total adjustment to net income. If we add that to our net income of $627,744, we arrive at net cash provided by operating activities of $622,870. What's really unique here is that our net income is $627,744, but the cash impact of all those revenue and expense related items is actually lesser. It is only $622,870.